Welcome back to Thimbleberry U. I am John J. Gay. I'm joined once again by Amy Walls from Thimbleberry Financial. Good to be back with you, Amy.
Always good to be talking with you.
So, Amy, today we're going to talk about something that is so important that not a lot of people understand or have the self-awareness to know about, and that is biases in investing. Why is this topic so important?
Well, we don't know what we don't know. I think that's the bottom line.
Mm-hmm.
It's easy to feel like the information that we know is what we need to, but when you can't recognize what you don't know, you can make mistakes.
Right.
When we don't know what we don't know, it's easy to think we're looking at all the information and that we're being open-minded. It's also human nature to have an opinion.
Oh, we all have those.
Yes, we do. And I'm right up there with everyone else. But recognizing biases and then finding the truth really allows for a better understanding of a situation and to take the emotion out of decisions.
Right. And we've talked about this before, that part of your role as a financial person is to be psychologist sometimes for your clients. So what are some of the common biases that people have when it comes to investing?
Yeah, there's a lot of them. So I'll just touch on a few.
Mm-hmm.
One is confirmation bias. And, yesterday was Super Tuesday.
Mm-hmm.
So we tend to want to avoid politics here, but politics is the perfect example for confirmation bias. If we're getting our news and information from specific sources that tend to agree with us, then that's confirmation bias.
And that's true whether you're watching cable news and again, we're not going to play sides politically here, but Facebook has an algorithm that they're more likely to show you posts from people that are on your side of the aisle and agree with you politically. So believe it to be true if somebody is saying what you've already been thinking.
Yep. It's just finding the sources that will validate your belief. In investing, for example, it might be the belief that low-cost ETFs are always the best way to invest. Mm-hmm. First of all, if anything is always, I think that's a good clue to run. They can be a great way to invest. I don't argue with that at all. But how this plays out is someone looks at the return data for the last few years. The issue might be that the information there doesn't include all areas of the market or what happened in a downturn compared to other investments. And as I said, all of anything doesn't account also for someone's personal situation. When they need the money, what their risk tolerance is, what their reaction is going to be to a negative market, those types of things.
So on those points, yes, you might be talking to somebody at the water cooler at work. They might be 20 years older than you, 20 years younger than you. They might have a wife and kids, or you might not have a husband and kids. And everybody's in such a different situation, so what's good for one person is not good for another. And then you talked about looking back at return data last few years. You could look at a stock and look at the last 10 years and see the numbers. That wouldn't take into account the crash of 08 and 09 because we're more than 10 years out from that now.
Exactly. So it's a matter of what you think is often what you're going to research or Google, just from a search term standpoint.
Mm-hmm. So the next one I want to talk about, Amy, and there's, again, so many of these biases, we only have time for a few today, but talk to me about loss aversion bias.
We have seen this recently in the markets with the sell-offs related to the fears around coronavirus. I know last time we said we wouldn't touch on that today, but I think it's important.
Yep.
And we talked about it then too. As humans, we're more wired to be afraid of loss than what we'll miss out on gains. And so if you miss out on the 10 best days in the market from January 1, 1980 to January 1, 2019, so 40 years, you would have less than half of the amount than if you just stayed invested during that whole time.
If you had just ridden it out as opposed to getting out and getting back in, you would have a lot more money in the end. That's really important to know.
Yep. Another bias that I think is important is, actually, before I talk about this one, Jag, let me ask you a question. Will you give me $100?
No, I'm not going to give you $100. That's a weird question.
I know. It's kind of random. And that's what I expected you to say. But would you give me $100 if I use it to make sure that the next time we record, we have really, really, really good coffee?
Okay, now you're tempting me because I really love my coffee and it's one of my vices, but no, I'm not going to give you $100 to make sure we have really good coffee.
Okay, fair enough. Well, Jag, I have $100 for you.
Okay.
It's yours. Here you go.
Okay.
Okay. Now, let me ask this question again. How do you feel about me using or giving me $100 so that I can buy us some really good coffee?
Okay, so now I'm more tempted because I didn't have this $100 5 minutes ago, but I have it now. It's almost like found money. It wasn't in my budget. Yeah, go out and get some of that Jamaican Blue Mountain really high-end coffee. Well, I'm good with that.
Okay. So this is a bias called mental accounting, and it's a silly example, but it works. And you made the point there that found money, free money, easy money. We think about that kind of money and how we spend it differently than we think about money that we had to earn.
And that we've planned for. I mean, for example, for me as a small business owner, if I sign a new client that I wasn't expecting to have in my bank account this month, hey, honey, it's Friday night. You want to go out to dinner? So your point is very well taken there.
Yeah, we have to, as an advisor, I have to be careful of this with clients. You know, we do work a lot with clients in tech and clients who get this easy money at times.
Or unexpected money.
Mm-hmm. And one of the places that I really have to watch for that with them and helping them put themselves in the best situation is simply around cash reserves.
Okay.
You know, it's really easy for people to forget to have an adequate cash reserve.
Yeah.
And it's important. And so you can either fund a cash reserve from, you know, your income that's coming in on a regular basis, in which case people tend behaviorally to hold on to that cash reserve because they had to work for it.
Yeah, it's almost like it's worth more because I put blood, sweat, and tears into this.
Absolutely. And sometimes we'll get a new client that doesn't have a cash reserve, but they just did get a windfall, you know, an inheritance, or you see this with lottery winners. And we also see it with our tech clients because they have stock they can sell. And so how about I just sell the stock to fund my cash reserve?
Right.
Well, the issue there is mentally, if they just got to sell stock or they get to use a part of an inheritance to fill that cash reserve, they didn't put in that blood, sweat, and tears. And emotionally, they're not as attached to keeping that cash reserve, and it often will disappear.
I see. Man, that Ferrari looks good.
Absolutely. Another one is the illusion of control, or sometimes called self-attribution.
Okay.
This is about thinking we can do better at something than other people.
My wife and I call that being the smartest person in the room, which we've both been accused of by coworkers many times.
Yeah. This is, you know, next week I'm flying across the country and getting on a plane. I don't mind flying. I actually like, if I have the right kind of work to do, like cozying up in my seat and kind of being in this little cocoon where I can not be distracted and just do what I have to do.
In the zone.
Mm-hmm. I get a lot done then. However, when there's plane crashes, it's easy for people, sometimes myself included, to think it's safer to drive.
Okay.
Right?
I've fallen victim to that, yeah.
Instinctively, like, because we're driving on a daily basis and in a car on a regular basis, that it's safer than flying. But we know statistically it's not. So this is an area where we believe our control, our ability to manage that vehicle and respond, right? If a car swerves, we can swerve out of the way, makes us safer in getting somewhere, when in reality, that's not the case.
Right, you have that self-control, but every statistic ever shows that it's statistically much safer to fly somewhere than it is to drive.
Yep. So I talk about that flying, and I think given the biases we've already talked about, I don't like takeoffs.
Okay.
I don't like them. And I don't fly a lot, but accidents related to takeoffs tend to stick with me.
Okay, because it's confirmation bias of something that you're already a little nervous about.
Yep. And if I were to Google plane crashes, I'm probably going to Google plane crashes at takeoff.
Yeah, I'm a stands to reason.
I probably am naturally. So, as you said, that's a form of confirmation bias, but it's also recently a form of recency bias.
Okay.
And that is because many of the crashes that we've heard about over the last several months have been at takeoff. And so that can heighten my fear that something's wrong, but that will stick with me because it's already my fear and because it's recent. So it makes it a little harder to fly. Once we're 10 minutes, 15 minutes in, I'm fine. But
once you can put that tray table down and pull out the laptop and get to work, you're good.
Yep. But I remind myself when I'm in the plane and we're ready for takeoff and taking off that, no, this is my bias telling me that this is not safe.
Okay.
With investing, recency bias is most often seen in wanting to invest more in the last great thing.
Okay.
So 2008, that was real estate. You know, every time you turned on the TV, there was an infomercial about how to win in real estate, right? And then not only did the stock market go down, but real estate went down.
Yep.
Recently, it's been gold. At least when you turn on the TV.
Especially at like 3 a.m. I found. Like at around 3 a.m., all sorts of infomercials about gold if I can't sleep.
I don't turn the TV on at 3 a.m., but I'll take your word for it. Also, it's the FANG stocks.
And remind me again what the FANG stocks are, Amy?
Yes, they are Facebook, Apple, Amazon, Netflix, and Google.
All those big tech companies. Okay.
Yep. And a lot of the return in the last little while has been due to those 5 stocks.
These are all important biases, especially when they compound on each other when you have more than one working at the same time. And there are a lot more, right?
There are. These are just a few of them.
Okay, what can people do to avoid falling victim to these biases and making these mistakes?
Have a plan.
Yeah.
Make sure that plan includes risk strategies that account for your true risk tolerance. If you can be invested one day and the next day feel like you need to be out of the market, then you probably have a lot of work to do in this area.
Yeah.
Not only in terms of your own thoughts and education, but in terms of your portfolio.
Mm-hmm.
Also, if you're still saving, have a plan to invest systematically. Dollar cost averaging, putting money in at regular intervals can be a really good way to do that.
Okay.
Also, have a professional to talk with. I'm not talking about your coworkers at the water cooler, and I don't mean a therapist or a CPA, who are both terrific people, but find a financial advisor that focuses on holistic planning and wealth management, and plan to have a long-term relationship with them, because they will learn you and they will start to learn your biases and learn how to help you counter those biases. And sometimes you'll be aware you're doing that, and sometimes you probably won't. But it's good to have that mirror held up.
We've talked about this before, Amy. It's such an important relationship to have with your financial advisor, because you're talking about your future. You're talking about your money. You're talking about your ability to have the life that you want to have both now and when you're done working and you're into that retirement phase of your life.
Mm-hmm.
It really is so important, because we all have biases. By human nature, we all have these biases. And again, like you said, we only scratched the surface here. There are so many of them. Having that outside perspective to say, hey, you're not looking at this objectively. This is where your bias is coming in. Having that person that you can trust, that knows you and knows where your biases are, like you said, Amy, and has your financial best interest at heart, is worth its weight in gold, as seen by this infomercial at 3 a.m.
Vanguard actually did a study on this. It's called Advisor Alpha, and other companies have done it too. And having that person and helping them through these kinds of things adds a 2 to 3% increase in return. Think of it like rate of return, but it's not just on investments, to your overall situation annually.
And if you're investing, 2 to 3% is a significant chunk of change. So if you want to reach out to Amy at Thimbleberry Financial, what are the best ways to get a hold of you, Amy?
Look us up at thimbleberryfinancial.com or give us a call at 503-610-6510.
Awesome. Great talking to you. As always, Amy, safe travels, and we'll talk soon.
Thanks.
Registered representative. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA, SIPC. Investment advisor representative. Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated. Cambridge does not offer tax or legal advice. Thimbleberry Financial is located at 650 Northeast Holiday Street, Suite 1600, Portland, Oregon, 97232.